One last thing about financial modeling and just the whole financial component is really there's some terms that are used in the startup world and the investing world that I think it's important you understand. One of them is burn. Burn is how much cash are you burning a month? It comes from your cash flow statement. How much is burning on it? And it's not off your income statement. This is a true cash. How much is going out every month? Next part of burn is really runway, which is based on your burn. How much money do you have and how long will it last you? That's your runway. So if your burn is $50,000 a month, you have $500,000 in the bank, you have a 10-month runway, okay? Very simple numbers, but you want to make sure you understand those terminologies. Some other terms, and these are kind of real obvious, but I want to make sure we cover them, are the types of investors. You have VCs or venture capitalists. These are entities, they're institutional investors, which means they are based on structures of funds. They've raised money that are generally in 10-year funds that their managing partners are to invest in different companies and get some sort of return on it for the limited partners, which are the people who put their money in the funds. You have angel investors. Angel investors are really anyone that could write a check to you. They may write a check for $5,000. They may be able to write a check for $1 million. Sometimes we call them super angels, which are ones who can write large checks, generally over $100,000 individually. There's also angel groups that come together and do angel investments. But these are the people that help you on your early stage seed investment, getting off the ground, before you get to the institutional level investors. Some of the other institutional investors are private equity guys. These are, again, fund managers, much like VCs, but their funds are really focused on buyouts and really more strategic into different types of investments, not early stage venture investments, but they occasionally do, play in the early stage startups. And the last one is a strategic investor. Strategic investors are generally companies who have some interest in your business or your technology and are willing to invest in it now to see how the company evolves with the intent generally either to be able to leverage it in their own business later on or even acquire you in your time. So strategic investors can be very good, but just one caution, if you take one on as an investor, it may push away other investors that are strategic. So let's say you've created the amazing e-commerce piece of software and Google wants to invest in it. Amazon may want to invest in it in the next round, but say it will pass because Google's already in it and they're competitors. A last way to get funding, or it's a really popular way right now, is called crowdfunding. And this is where you post on some site, Indiegogo or Kickstarter, and there's many other alternatives out there. You pitch your idea, your product, you put it online, and the crowd, the internet crowd, whoever it may be, if they're interested in an idea, they put money into your company in generally very small amounts. And they get something out of it, maybe first shot at the product, they get a prototype, may get full access to your website, what have you, a lot of different variations for it. So that's kind of a term to be aware of. Now, you don't have to take money from anyone in a startup, and generally that's the best way, is keep your startup as lean as possible financially in the beginning until you really prove something and can increase your value. This is called bootstrapping. Bootstrapping is when you use your own money to get the company off the ground and take it however long it can be. Now, another term that gets thrown around, I think it's important to understand, is the term of dumb money. VCs like to use this. VCs like to call themselves smart money, which is they're advanced investors, they make intelligent choices of what they're doing, and they hopefully bring extra skills and tools and advice to a startup or connections that the startup can use. Dumb money is generally sometimes strategic money, but often angels who like an idea, throw the money in, or friends and family for it. Don't really consider it dumb money. Money is money and your investors are important, but the term does get thrown around a lot. Another key terminology is investment rounds. And what you'll hear is seed, Series A, Series B, Series C, growth rounds. These are all just rounds of capital and they're different stages. Seed is just that. This is your first round of money, maybe the first 2 little bits of money you take to get your first product up or your first store going, what have you. Your Series A and Series B are just that. They're sequential levels that generally come through institutional rounds. They're often preferred shares, but the structure changes a lot. And that's all you need to know is that investments come in rounds and they're given different names, and there's no real exact rule of what you had to do. I've been with companies that have had Series A, Series AA, and Series AAA for certain reasons that were unique to that company. Some of the most important terminology to know is something called a liquidity event. And sometimes that makes some newer entrepreneurs a little nervous. But liquidity events are when something happens to give liquidity back to your investors. And you as a co-founder are an investor in that company, you own shares. It may be an IPO where you go public, on the stock market. It may be an M&A, which stands for mergers and acquisitions. This means someone has bought you for it. Either one of these can be called an exit strategy. Now, every startup generally has an exit strategy. We hope to go IPO, we hope to go M&A. Really, it's up to the market what your exit strategy is. A good example recently is Groupon. Groupon had, at least we rumored of a big offer from Google to buy them, which would have been an M&A. They declined because they thought they could get more money by going public, which they did. And they did go public. They didn't make much more money than the offer, because it was not a well-received IPO, but then the stock has crashed down, so they're now facing their own issues. But it's something to think about an exit strategy when you're thinking about your business plan. And the last two terms I think you need to understand are return on investment and IRR. IRR stands for internal rate of return. Now, return on investment is just that. If someone puts $5 million into your company, a VC, and they get $10 million back in a liquidity event, they've had a 2-time return on investment. 2x was the phrase. Now, most VCs want a 10x return on their investment. So if you're going to take $5 million from them, you've got to be pretty confident that you can grow the company and get it to worth more than $50 million, because probably you have other investors and your own share of the component on an exit to give them that 10x. Now, IRR is a term that's used more for those who have funds that are managing it, so VCs and private equity, and it's the average return on all their investments in their fund. Not something you need to know too much as an entrepreneur, but it is something that does come up with VCs, because they may be looking to invest in a really big risky deal, and they may be doing a couple smaller ones that they know are going to give them a more stable IRR.